Today is Friday, January 9th, 2026. And my name is Francisco Gaffney, and this is my daily streaming all about governance, risk compliance, and advisory boards. So, a quick recap of what happened this week. We separate profit from resilience. I looked into execution breakdown in early scales. I talked about inventory as a liquidity and governance issue. And yesterday, we tested whether the operational model is a person run or a system run. And this is very important because a system run operation becomes an asset. And this is very useful for future, like if investors, funding, mergers, acquisitions, or other activities. So today, I will close with a single measure that pulls all this together, which is a revenue per person. Because boards can debate narrative for hours, but this number, the revenue per person, force honesty, if you may. So let's take a look at three problems with this. Number one, the UK productivity remains a constraint. So that is not new. It's also reported by the UK Office for National Statistics that output per hour in Q2 2025 was 1.5% above 2019 levels. That was pre-pandemic, and continues to flag weakness in underlying productivity growth. So that means when productivity is sticky, adding headcount often increases costs faster than capability, unless methods and systems change. Problem number two is that governance expectations on controls are tightening. The UK Corporate Governance Code 2024 asks boards to make a declaration of effectiveness of internal controls and extends the scope to reporting controls, including narrative reporting. In other words, if performance depends on informal heroics, the control story becomes harder to evidence and defend. And here's a big point, because evidence is the best defensible position that you can have in front of notice, audits, inspections, etc., etc. And problem number three, this is coming from a real example from the PLC I was observing last week. Their annual report shows 129K in revenue recognized in financial year 24, alongside material uncertainties around going concern and significant funding challenges. So when conversion remains fragile, headcount growth can mask a lack of repeatable assets until cash pressure forces the issue. And I will explain this as I would explain this to a golden retriever, and pardon the example, but I took it from Jeremy Irons in the movie Margin Call, when he was speaking to an analyst in the board. And he said, explain this to me as a golden retriever. And he said, if revenue is rising, but revenue per person is falling, you are filling the bucket with a wider hole, meaning that actually it doesn't matter how much revenue is collected, the bucket has a wider hole, meaning that actually you're spending more money than actually you are coming into your organization. So here's a board trap. Revenue rises, so the team grows, the organization feels busier, but the business does not get easier to run. So meetings multiply, decision cycles slow, and risks moves into the gaps between the teams. So that's why revenue per person matters. It's not a vanity metric. It is a proxy, if you may, for whether the company is learning to produce more with the same structure. And this is a key. And in the UK environment where productivity is constrained, that really matters. So as a board advisor, what I would propose to consider in these cases, number one, use the revenue per person as a system signal, not a judgment of the individual. This is not a performance review. This is not it's nothing like that. It's a system signal. Track it alongside delivery indicators to see whether systematization is improving output. And so you like to catch weak productivity trends where output does not improve automatically with more effort. So it's a phrase that actually is frequently heard, that is, throw more bodies into it. It doesn't really matter. because you are looking for output. It's not just to throw more people or hire more personnel or teams. Doesn't really help if you don't really have a system that can sustain that increase of personnel. Suggestion number 2 is link revenue per person to control evidence. This is back to what I just said. Ask management what has become repeatable, documented, and measurable since the last period. So the governance code, as a reminder, focus on control effectiveness and reporting controls, which means board need proof of how performance is produced, not only what was produced. And number 3, the third suggestion I would make is challenge the pipeline optimism with a conversion reality. Yeah, back to our PLC example I was observing last week. Their reporting is a practical reminder that pipeline and recognized revenue are not the same, and that conversion gates and concentration risk really matters. So revenue per person improves when conversion becomes a system problem, not when activity increases. Right. So this is a shift that you may observe. You will stop asking only how fast are we growing, and you may start to ask if is the organization becoming more productive as it grows. So if it grows, the productivity should be increasing. So if the answer is no, it usually means that one of these 3 things: the work is still bespoke, so is on somebody's shoulder or a team's shoulder, not on systematization. The method is not codified, meaning that people are learning as they go along every single cycle of the process, because actually they have to relearn the thing again because it's not systemized. And systemization doesn't mean software, by the way, all the time. Or the controls are not embedded, so they are not part of the process that they follow in terms of producing revenue. And those are board level design problems. So what we should do in these cases, I will look into 3 things: outcomes, differentiators, and risk reduction. In terms of outcomes, we use the UK Office National Statistics productivity pictures again, and makes the case for the system-led outputs. System-led, that's a key word. So meaning in a low productivity environment, unit efficiency becomes strategic, not optional. So it's a strategic outcome. Number 2 is a differentiator. The UK Corporate Governance Code 2024 reinforces the board responsibility to evidence effective controls, including controls over reporting. So improving revenue per person through systematization strengthens both performance and control credibility. And how that helps to reduce your risk? And again, back to my live example of the PLC listed on the London Stock Exchange, disclosures provide a live illustration of why boards must separate narrative from repeatability, and why conversion and systematization determine whether growth hardens into durable performance. So revenue per person is a simple lens that exposes whether the model is becoming an asset. And we spoke about assets earlier. It's important to have that asset as a methodology, a system in your company, because actually it helps in many areas in terms of investors, funding, mergers, acquisition, etc., etc. So what should boards do with this today? Not a new dashboard with another 50 KPIs, not a major reorganization, but let's do a single exposure test that will suffice to bring another view of this. So one action today that you can do is to calculate the revenue per person for the last 2 reporting periods, and ask management what specific system changes explain the direction of travel. So look into the last 2 reporting periods and which way the system is going, right? So which is a trend that you're finding there. If there is no clear explanation what's going on, then it's not a data problem, it is a design problem. And design problems, guess what, can be fixed. So if you are in the management team or the C-suite and you've been asked by your board about this in a PLC or a limited company too, and the board is asking to improve the revenue per person through systematization and tighter conversion controls, It's very simple. Book a structured diagnose session control with your own team, where you and your team identify the highest leverage processes to codify, or if they are codified, and the control evidence needed to report confidently to the board. So what's next steps? Just stay tuned. So because next week I will discuss when financial restructuring exposes the real business model. And I will share observation from a large PLC I am currently watching on the London Stock Exchange. The company is undergoing a complex debt restructuring, workforce realignment, and strategic repositioning under intense time pressure. So it's very interesting because it might happen to any company, a limited company or public company, large or small. So the purpose is not to commentary on one company, but to surface repeatable board level lessons, right? And like, comment, save this post, and join my 765 now plus newsletter, LinkedIn subscribers to keep receiving these and many other useful insights on how an advisory board can help your organization. And if this is relevant to you or your organization, I'm happy to compare notes how to advisory board can help you and understand which is your position and what we can do for you. A short Zoom call or a message through LinkedIn will open the conversation. So